When I look at what moves Bitcoin, 90% of the entire price action is explained by liquidity. So, yeah, we build complicated models for that. How do people look at it? Pretty simply, look what the dollar's doing. And the other one is look at global M2, which I think you can get on TradingView. Those two will give you a pretty decent idea of the forward direction of the market. Global M2 leads by about 3 months. So that's an easy way. Our financial conditions, easing or tightening, is liquidity coming into the system.
So what's M2 saying right now?
M2 says, and it's been mapping like a 98% correlation recently, which is very high, and it won't last, but it just basically says up only all the way through to the end of the year.
And is this only for Bitcoin, or is this
alts
as well?
So what happens is, particularly at this phase in the cycle, which is the debt refi cycle, what usually happens in year 4 of a crypto cycle is that alts start to pick up as well. So risk-taking goes out the curve and goes further out. So Bitcoin dominance tends to be high, with a few projects that have been chosen. So Solana and Sui have probably been the two of the last 2 years. But what happens in the last...
It's all about liquidity.
It's all about liquidity.
Okay.
So when liquidity is drying up in the system, there's less volume.
Right.
When liquidity is plentiful, people have more money. Now, one of the things we've got right now is the business cycle is still pretty negative. So the ISM below 50. What does that mean? It means companies aren't earning as much and households aren't earning as much. So therefore, people aren't taking as much risk. As liquidity comes in, people start recycling capital into financial markets, volumes go up. So we saw that at the back end of 2024, Q1 was the payback for the strong dollar and high rates that happen with the 12-week lag. So it's all liquidity.
Right. Well, but
corporate earnings are liquidity and business cycle too.
If we're looking at the crypto public markets, sure, but at the same time,
early stage is different.
Right.
I also run as a fund of crypto hedge funds. What we're finding is VCs get in early. The price of the token generation event is generally too high for the market demand because of liquidity. So what happens is the tokens drop early, and then what it leaves is the hedge funds, who are really the primary sources of capital in the secondary markets, and they're not that big to find tokens now at a discount. So these things all fall about 70%, and it gives them a secondary opportunity. That is the same opportunity retail gets as well. So it's not to buy the token generation event, it's let it settle for a month or two, and then look at classic, network adoption model. What's getting adoption? I use kind of Metcalfe's law approximations to do that, and you can find from that great opportunities. So you can get a double stab at the same thing, which is why we're seeing these hybrid funds as well that will also, do the early stage, get the token, do the token generation event, and also will buy tokens. So there is opportunities for retail within this.
Okay.
And we're also seeing, by the way, I think in general with venture, major pullback on any kind of fundraising round pre-TGE. Just people are...
There's still a skew, which is VC versus professional capital in secondary markets, right? The hedge fund industry is about $12 billion in crypto. It's $4 trillion in traditional markets.
Right.
While VC, let's say, take a peak of 2021, raised $64 billion. So we've got, what happens is these token generation events happen, there's just not enough professional capital, which means that for me, the hedge funds have huge alpha because they're not competing with, there's currently in the US, there's more hedge fund managers than there are managers of Taco Bells. Like there is so many, right?
Okay.
So that's how competitive that market is.
But why do you think there's such a big delta?
Because they haven't been able to raise capital yet.
But why? Why aren't they able to raise capital if the alpha's there?
Because it's easier for investment committees of family offices and institutions to put it in the VC bucket, because then they don't have to say it's crypto. They can just say, oh, it's technology.
Right.
And then they don't need mark to market because they don't know how to deal with the volatility.
Right.
So these hedge funds are volatile. If they're directional, they're very volatile, but the returns have been stupidly large. But the investors, Oli says it, everybody says it, is like, people are not building enough applications. So we can build infrastructure stuff. We can build, the financial stuff will happen anyway. There's so much incentivization to get involved.
But when you say applications, does that mean social? Does that mean games?
I'm where do the billion people come from? Where are the 2 billion people? Well, finance is one of them. Okay, we know that. But then there's the big cultural communities of gaming, entertainment, sports, social media, all of these things. We've failed to get any of those any traction. But as soon as one of those happens, it's going to change this entire industry of crypto, because suddenly we go from 500 million active users, or 600 million where we are today, We will go to 2 billion, 3 billion. Digital ID, one thing could easily get 3 billion users. Okay, that's a game changer. They're not monetizing you.
That's exactly.
And the idea of Web3 is we can monetize ourselves. So it's a broader distribution of the capital available that gets monetized. So everything we do is time is money.
That's right. That's right.
Our time, our attention is money.
And the other thing, by the way, that I'm very complaining about this one in crypto is that every time something works,
the thing is a function of customer demand. So the big pension plans, the big pools of capital, they've barely done anything. I mean, barely done anything so far because the regulatory environment's been so difficult. So we've got all of the endowments, all of the pensions, the insurance companies, the reinsurance companies, these massive pools of capital, hundreds of trillions of dollars, have barely started. So the banks and the entire financial industry, you're seeing Apollo tokenized funds, stuff like that. Well, who really wants to buy that stuff yet? Their customers can't do it. So they're solving small parts to test out the technology. This whole thing really is going to play out over the next 5 years and not the next 1 year because these guys don't move at that speed.
Got it. So institutions are coming, but of a different kind than the one that we already see.
Yeah, they're here, and there's various component parts that need to change. And a lot of this, to get equities on chain, that's a big battle amongst so many incumbents.
Right.
That's the hard thing.
As you were mentioning.
And they're also not startups. It's not like they're here and then all of the apparatus, they're going to be on chain. The second one that I like, but it's kind of like more pie in the sky, is this thing that I've been calling generative finance, which is most of AI to crypto combination is obviously not very real. Like a lot of these things are not real. But one thing that is kind of interesting is I can say two statements that are pretty uncontroversial. One of them is that right now we have the ability of turning language into code. And those are LLMs, and it's only getting better. And the second statement is we also have the ability through DeFi to turn code into financial instruments. So if you take one and the other, that means that we have the ability to turn language into financial instruments. And that is what I'm calling generative finance, which is pretty cool. So a lot of innovation. I don't know if it's this cycle, but a lot of stuff will come from hyper-specialized financial products, hyper-specialized products that can just be built on top of this combination.
Okay, so nothing about liquidity.
Nothing about liquidity.
Okay. Next 12 months, what should we see?
I think IPOs, and that's a big deal. VCs need to recycle capital, and the investors need to recycle capital. That is liquidity. But we're at the B this year is going to make a big stab at digital ID. That has to happen. We cannot have AI. We don't know who's who on X anymore. This is a massive problem that's going to have to get solved, and somebody's going to have a stab at it.
Excellent.
Like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support. Enjoy the video.